Welcome back. The Aussie dollar has been under pressure this year with rising interest rates and China's lockdowns reducing economic demand for our resources. Business reporter Ingrid Willinge caught up with Westpac currency analyst Sean Callow a little earlier today.
So only a week to go to GDP. So the Aussie dollar, it's actually under pressure today. I don't think too much of it is due directly to the CapEx report, even though it was a little bit of a disappointment relative to expectations. But really, it's just a very bad vibe in the markets at the moment, and the Aussie often falls when equity markets are under pressure.
It's interesting because I know you've been watching key support levels, and potentially the Aussie could fall through those support levels, but it seems weakness is limited at the moment. What's driving that?
Yeah, that's right. You'd think that we've had like 4 consecutive days of the US stock market selling off, a lot of bearishness around China and so on. The Aussie's down a bit, but nothing dramatically. And so really what we've been looking at is we've got an unusually large amount of Aussie being bought from the conversion of mining company dividends. So it's obviously only seasonal. These dividends, profits very high, dividends very high for all the Australian shareholders who, of course, don't want their profits in US dollars. They want the Aussie. It's that time of year, essentially, and we're talking many billions of dollars. So that's running through at the moment, probably run for another week or so.
And then we could see the Aussie break down?
Well, that's right, yeah. So it just stops, of course, once they've bought what they need for the shareholders to receive their dividends in Aussie dollars, then sort of middle of September. Then I think the danger is, if we've got more of this focus on the Fed and a strong dollar and worries about China, then we could be looking back towards 67 cents.
I want to go a bit deeper onto some of those factors driving the Aussie, and you mentioned obviously interest rates, which we'll get to in a moment, but China, Aussie often seen as a proxy for Chinese growth. Yes. We've seen another Chinese city go into lockdown today at Chengdu. We've got the Congress coming up next month in mid-October, where China's expected to go even harder on COVID zero, that tight policy. Is this expected to play out on the Aussie in the long term?
Yeah, look, I think there's already an expectation in markets. Investors are indicating that they're already worried about this and that they are playing that through the Aussie dollar, because you can see in the futures market, the positions from the speculators, they're actually already short the Aussie dollar. So and that's been increasing. So the worries do seem to be there. They're worried about the property sector in China. As you say, these lockdowns, well, the world knows from experience how difficult it is to operate your economy when you've got lockdowns. Particularly they're unexpected, they're sudden, and they just really interrupt business. And so through that threat to growth, I think a lot of people think that Australia can lose a lot more than other currencies.
And interest rates are interesting at the moment. It's the big one we're watching. We've got an RBA meeting next week, which we'll get to, but we're also watching the Eurozone. Inflation topped out. We've watched that happen. There is, thoughts that perhaps we'll see a 75 basis point hike there. We're seeing the US looking like it's on a trajectory of rate hikes continuing. Yeah. So where does that leave the Aussie?
Look, because our yields have been rising as well, in terms of the spreads between the Aussie and other currencies, it's held roughly steady against the US. I guess the surprise is the euro. Over the past week or so, there's been a sudden surge. There's been market talk that the ECB will go from 50 steps increment to 75, as you say. That's next Thursday night. So that's been helping the euro. So the Aussie has fallen a little bit against the euro the past week, but against the US, the yield spreads haven't changed as much, partly because the RBA just seems to be playing catch up, really.
Yeah, so that's been a hot topic of conversation, of course, this year. We'll be looking at potentially the 5th rate hike next week from the RBA, 5th consecutive rate hike. What's Westpac's view? We're
looking for a 50 basis point move, so another one. The statement itself may be more what we're expecting. The market's pretty much ready for 50 basis points. So in the statement, will there be any hints about are they more worried about inflation than previously? Do they think they might need to continue with 50 basis points? Because we were starting to think that they might be ready to move back to 25 basis points and just sort of take it a little bit more gradually, bearing in mind that the RBA, of course, meets every month, and the Fed and so on, the ECB, they only meet every 6 or 7 weeks.
It's just such a balance, because some of the forward-looking indicators we've been seeing, the PMIs, for example, were quite a big miss, and these ones have been quite negative. And then you look at some of the backward-looking data like retail sales, which has been really strong. So you do get this impression that the RBA has to tread a fine line. We've also got Phil Lowe speaking next week. That'll be important.
Yeah, that's always a big event, the Annika Foundation. So he can give us some real colour there. So if on the statement on the day, we get what's the rate move, bit of background, then he can really add some colour about is he going to do a bit of a Jay Powell and sort of scale things up and send a very direct message to markets.
Yep, it'll be really interesting. Big week next week. Sean, really appreciate your time today. Thank you for joining us.
You're welcome, Ingrid.